I'm Corbett Wall with DV Auction, here with a cattle market summary for the week ending August the 5th. The cattle market really impressed this past week with another big Monday just like we had a week ago. Starting out with live cattle on Monday up $2.35, Tuesday was up 50 cents, Wednesday was up 52 cents, Thursday fell off 42 cents, and then Friday was back up 6 bits to end the week at $115.52, which was $3.80 higher for the week. Feeder cattle on Monday was up the limit, $4.50. Tuesday was up 80 cents. Wednesday up $1.72. Thursday off 37 cents. And then Friday up strong again, almost $2 on Friday to end the week at $147.20, which was up $8.62 for the week. You look at your August contract on the feeder cattle, which is really just trying to get in line with the index, and it's at $149.65, and it's leading the index quite a bit, so we're expecting feeder cattle to be quite a bit higher this week. You look at the live cattle contract on the August spot market at $117.67, and it's trying to chase down cash, but still about a $2 basis there. But look at your fat cattle trade for last week. 80,500 head just through Thursday, so you figure in some cleanup sales on Friday. It's going to be a significant negotiated trade. We always talk about how watered down our negotiated trade is these days, but actually this year it may be just a pinch better, which would be a major shift because it's just been falling for the last 20 years very, very steadily. But you look at cash sales, 118 to 120. A lot of 119 out there, and that weighted average is going to be right around 119. That was mostly $2 higher for the week. That 120 was late in the week, so that was another positive sign. Look at dress sales, 187 to 190. There was a lot of 188, and that'd be $1 to $2 higher for the week. Slaughter, another significant slaughter, and we've really been getting rid of these fat cattle and staying really current, and they're moving that beef through the pipeline, which is very, very important. But you look at the slaughter this past week was 579,000, just 2,000 less than a week ago or the previous week, but 45,000 more than the same week last year, which is very, very significant. You look at your CME feeder cattle index is at 146.03. Like I said, August spot feeder cattle 149.65, so it's got some catching up to do, and it's kind of strange with the cash sales trying to chase down the board, but that's what's happening in the feeder cattle after an impressive week there. Real-time index is higher than the CME index at 146.74 because it reflects Friday's sales, which were higher in all the big markets that had a sale on Friday. But we wonder whether this cattle market in general is overbought. Yes, it probably is, so we might have to brace a little bit for some selling off on the board, especially on feeder cattle, but also on the fats too. But we think we've pretty much bottomed out. We've bottomed out probably on the board a week before this last one, and we've probably bottomed out on cash fat cattle, and we think now this week that we've bottomed out on the box beef cutout values. So that's a good thing. The thing we need is some out front support on the board. All of our strength and all of the strong showings have been on the spot market, and we think that we bottomed out and everything's going to get better. Well, where's that reflected in these out front months down the line, so people can lay off some risk, and maybe some of these feedlots can get that board raised up on the fat side down the road, where they can get out and try to buy some of these feeder cattle little heads, because they just won't do it now, because there's no way these out front numbers on the live cattle board, you can't make it work. They're just not high enough. But hopefully if we convince everybody that we've bottomed out, maybe some of these long speculators will get in there and start buying up that board down the road a ways. Look at box beef cutout values for the week. Your choice cutouts, the average for the week at 198.71, which was down just 8 cents. And like I say, it's just trying to establish a bottom, but we think it did this last week and should be on the rise, maybe kind of slow though. Select cutout values 190.88, which was up almost $1 there. So we did see that reflected on the select side. One bit of news that we saw this week, I don't know if you guys noticed or not, is some changes on the CME It's mostly just in the live cattle contracts, but they're making some changes. There's been a lot of discussion about the live cattle contracts and what I just got through talking about, how we just don't see anything on the long side. We're not seeing any reflection of the market. It's not really a good indicator of what things are going to do. And they're trying to do some things to help with the transparency of it and stop so much of the volatility that's been going on. I'm not sure if these changes are going to do any of that, but the one major change that they have in there is they're going to change the live delivery process at Worthing, South Dakota, which most of you know I work for USDA, graded a lot of cattle at that new facility, Sioux Falls Regional Market there in Worthing, South Dakota. And since that's become a delivery point, that's been a real good option for those mostly farmer feeders up there in that southern Minnesota, northwest Iowa part of the country there. And those guys consistently have to sell a little bit back of what the rest of the 5 area is trading at. And this has been a real good option for them to mark cattle through delivering those cattle. Yeah, the problem is that the big deliveries come in the fall of the year. October is a big one. December is also a big one. I know I delivered or graded 100 loads in December of 2009 there, but October has been the big one. And now they're going to input a $1.50 discount on delivering cattle to Worthing, South Dakota in the CME delivery process, which is really a bad deal. You know, those producers up there are running behind all the time anyway, and this has been a real viable way for them to market their cattle and try to get what the rest of the 5 areas doing. Now the CME's putting another $1.50 discount on them just for them trying to get what they deserve in the first place. And I don't agree with it. A lot of your congressmen out of the Dakotas area there, they didn't agree with it. And basically the CME wants to have the threat of live delivery, but they don't really want any deliveries to happen because they're just kind of a pain for them, and they would just as soon not have any of them. But they want to continue to keep the threat of delivery there to try to keep a little bit of open interest in that contract. That's why the feeder cattle contract has gone down to nearly nothing, because there's no threat of delivery. It's a cash settlement, and it's not a big deal at all. But CME wants to keep those cattle contracts, even though they're less than 2% of their business at the Chicago Mercantile Exchange, but they don't want to lose that business. But they're really putting a cramp on people that were actually using the board as a marketing tool. Another change that they're making, they're stepping up a par load from 55% choice and 45% select up to 60% choice and 40% select, which does kind of indicate the way the industry is going right now. Cattle have been grading a whole lot better than what they did maybe 5, 6, 8, 10 years ago. And better, I mean more, a higher percentage of them are grading choice. I'm not for sure if that's because we're making such huge carcasses, which I know that's part of it. I think instrument grading is another part of it. We don't have live individuals standing on the lines in most plants anymore. They take a picture of it and then the computer grades the cattle, and the computer doesn't have a conscience. So a lot of those cattle that were borderliners are going ahead and grading higher up in the USDA grades. And then the third and final thing that CME implemented is they're going to delay posting any live cattle contracts past October 2017 while they look at all this volatility and things like that. The problem is you got people that like to buy little bitty lightweight cattle and keep them all the way through. They're having a hard time because they're not finding any way to offset that risk. And you know, the CME might want to watch this, because I know at the Denver NCBA summer conference there were some people talking about maybe trying to find some other kind of a tool to lay off the risk, and wondering how hard it would be to set up some kind of contract that works better, has more transparency and less volatility. But we'll see how those things work. Look at cash feeder cattle this week, $3 to $6 higher in all your sale-borne markets across the country. Direct trade wasn't quite that much higher, but your direct trade is usually working off of the previous week's market, and it's a little bit slow coming in. but your calf prices were steady to $5 higher. Most of your calf markets are being created in the southeast right now, because you go into the Midwest and the plains, just not seeing enough calves move right now to really indicate what the market's doing. You look at an individual quote there in Lexington, Nebraska on Friday. They had 2 long strings of cattle there that sold. There was a 240 head string and a 210 head string. That adds up to 450 head of yearling steers there, weighing 868 pounds at 150, 110. Awfully good sale there. If you'd like to see this market report on a regular basis and you're not really sure how you found it, you can subscribe to it on YouTube at Cattle Market Central. You type it in on YouTube and then you can subscribe to it and you'll get a notice whenever it comes out every time. Go to Facebook and like DV Auction, and you'll see this report every time it comes out. Or probably the easiest way to go to the stockexchangenews.com, and that's a website that we support and post this market every week. But from a home office here in Canyon, Texas, we'll talk to you on Wednesday.